Frequency Podcast Network. Stories that matter, podcasts that resonate.
If you're long the markets, it's been a rough couple of days. Trillions of dollars in value wiped off globally. And it all started after the U.S. president announced his reciprocal tariffs last week. Markets have been mostly lower and very volatile ever since, looking for any good news to cling to. There might be signs of that now. I'm Kris McCusker, and in this episode of The Big Story, we take a look at the market meltdown and why it matters even if you aren't invested in the stock market. This look is coming after the U.S. president announced a temporary reprieve for some countries that did not retaliate against the American tariffs. Markets like the news, but there hasn't been a full recovery yet. Philip Petursson is Chief Investment Strategist at I.G Wealth Management. Thank you so much for doing this.
Great pleasure to be here, and any clarity that I can provide, I'm very happy to do so.
First, I want you to put this into context. This meltdown has been significant and unusual.
First, we need to take a step back and understand what kind of environment are we in. And so this is what we do as investors and portfolio managers. We try and understand, and the way I'm going to explain it is this a destructive event where we are seeing a permanent loss of capital somewhere in the marketplace, or is it more of a disruptive event where we have some economic headwinds, we have some bad policy, we have things, but they're not permanent, and for now, they're not resulting in this permanent loss of capital, which would be bankruptcies, bank failures, hedge funds blowing up. Those are significant market events that can rock the financial system. That's not where we are today. So the market response is more out of fear as opposed to out of anything more fundamentally based. Now, we know the tariffs create some uncertainty, but we don't know how long they're going to last. We don't know what the true desire of the White House is with respect to these tariffs. The market is responding more to the uncertainty than to the economic consequences, whatever they might be.
So if I read between the lines a little bit, do you see this as investors reacting emotionally?
In part, yes, because you're hearing more talk of, well, if this keeps in place, we're going to head towards a recession in the United States and Canada, and this is the worst thing for U.S. trade. That's all true, but we're not there yet. So the market is panicking, pricing in somewhat of the worst case scenario before we even know really the path forward.
In your position, it is your job to make investments on behalf of clients. And I read a stat today that 1 in 3 Canadians is invested in the market. If investors are reacting emotionally, are you reacting emotionally?
We're not, actually. We've been very rational through this, and I would say our partners that we work with have been the same. And I say that because when events like this happen, you don't want to react today. The right time to react would have been 3 months ago, 4 months ago, 5 months ago, which is what we did, so that you're prepared for the potential environment that we're in. So what I mean by that is we put positioning inside of our portfolios that were more defensive, meaning we favored bonds over equities, we favored international equities over U.S. equities, we favored gold. So we were doing things in the portfolio that we felt would mitigate the potential for some of the risk that we're seeing today. If you're responding after the market is down 10 or 15%, it's almost too late. And so that's what we're seeing out of some individuals where they're panic selling. That's not what we're doing. We try and remain rational, focus on the fundamentals, keep focused on the numbers, and keep moving forward.
So the average Canadian would be invested in markets, and I'm using air quotes, by way of mutual funds or ETFs, even if they don't hold like specific stocks.
Yes, that's true.
Is there some way that Canadians would be invested in markets that they're unaware of?
Absolutely. And it's a misperception, I would say, that could be out there. And many Canadians that would be in a defined contribution pension plan where the company is making contributions on their behalf into a long-term retirement plan. They might think, well, that's something separate, but most of the investments in a defined contribution plan would be directed to the markets, whether it be fixed income markets or equity markets in Canada and around the world. So I would say the majority of Canadians that have, whether it's an RSP, defined contribution plan, tax-free savings account, or what it might be, they have some exposure to the markets.
And that even is by way of interest rates and their mortgage as well.
Exactly. And the policies by the Bank of Canada and what's happening with bond yields across the maturity spectrum, whether it's short-term bonds or long-term bonds, that all can influence mortgage rates, that can influence borrowing costs, and it can influence GIC rates as well.
The other thing I'm curious about your take on this, I mean, I've been hearing this over and over and reading it over and over, and it feels to me like the tariff plan by the U.S. president in and of itself is one thing, but the bigger problem maybe is the uncertainty around the tariff plan. There's no end game. There's no way clearly for countries to have the tariffs taken off. So it's uncertainty about the plan itself, but there's an additional element of uncertainty that's creating the problem.
Absolutely. I mean, it's the poor communication coming out of the White House in terms of the justification for the tariffs, what the tariffs actually represent, what the government wants out of the tariffs. There's no consistency in terms of the message. It would be much easier if President Trump just said, this is what we want. We want to eliminate trade deficits, or we want to remove certain trade barriers. But if he would be a little bit more explicit in what that is, I think there would be less uncertainty and the markets could respond or would respond better. But we haven't got that. What we've gotten is just this mishmash of messages from whomever is speaking out there in the media. One person will say one thing, the other person will say another thing, and none of them line up. And that's the real challenge that investors are faced with. It's just tell me what you want and we can find a path towards that.
It also feels like it's very different than the first term that Donald Trump had.
Yes, and I would add to that, the difference between his first term and where we are today is his first term, he had individuals around him that would challenge these policies and would be the voice of reason and would say, maybe we need to rethink that. But it seems that the individuals that he's surrounded himself with today are people that are just willing to say, yes, sir. Yeah, absolutely, sir. That's a great idea, sir. And so he's not getting that counterpoint to say, well, if you do this, this is the potential outcome and consequence, and this is the harm that you could be doing to the American economy and American people itself. It seems that we're completely devoid of that.
Sort of on that, there are two fairly high-profile members of Trump's administration that are seemingly having a pretty public battle now. One of them, Peter Navarro, who was also a part of Trump's first administration, and it's out there that this whole tariff policy is his idea, and it's sort of been driven by him. And then there's Elon Musk, and Musk's Tesla stock is down, 40% this year, at least in part because of this tariff plan. So it makes one wonder if Trump is going to be forced to pick sides between those two. Is that something that has entered your radar when you make your decisions?
Absolutely. And not only that, what we have to almost take for granted is that this is a temporary event. And this is an event, while uncomfortable and creating volatility, ultimately, we have to believe that this will come to an end, either in a good way or a bad way. And I think leaning more towards the good way, because we're seeing the cracks. You're seeing the division within his own inner circle. If Elon Musk is this vocal on X, how vocal is he behind closed doors? You're seeing Republicans, key Republicans, Ted Cruz being one of them, who now are publicly coming out against tariffs. So when you're getting cracks like that in the Republican Party, the pressure is building. And whether it's political pressure, economic pressure, pressure from business leaders, or pressure from your voter base, eventually you'll take action to remedy the situation. If you don't, as Ted Cruz has said, then the Republican Party come 2026 midterms might be decimated. And that's something that, regardless of the ideology that Trump may hold on to, he is still part of the Republican Party and is responsible for the success or lack thereof in the coming election.
And that's sort of where this situation is so different, right? I mean, the problem with markets and economies in the pandemic, this was, it was a public health concern. There wasn't much we could do about it, so to speak. But this is almost you and I have spoken about this. This is kind of a self-imposed crisis.
Absolutely. And this is where you can be a little bit more comfortable in this situation because it can be reversed and the damage can be mitigated fairly quickly. This is, as you point out, self-imposed. I think that's a great way of explaining it. We say this is an engineered market meltdown. Right? As Trump put these tariffs on, everyone said this was a bad idea and this was the likely outcome. And here's where we are today. This is very different from COVID, which was one of these exogenous shocks that nobody saw coming, and yet we got through it. And this is very different from the 2008 and 2009 great financial crisis, which was an economic bubble of massive proportions that led to, as mentioned before, permanent loss of capital, whether it's the 400 plus banks that failed, the thousands, if not tens of thousands of Americans that were forced to walk away from whatever equity they had in their homes, and on and on. This is not that situation. And this can be turned around fairly quick if cooler heads prevail.
I know you've given some thought as well to, potential counter punches from Canada and what this tariff drama could do to the economy.
We have to think about the impact of the Canadian economy with respect to the tariffs that are imposed right now. And Canada almost got away or was spared from the broad-based tariffs of the Liberation Day announcement, where we still have the tariffs on steel and aluminum. But from what I understand, that's not stopping aluminum from getting down into the United States because the U.S. is dependent on Canadian aluminum and to an extent dependent on Canadian steel and certainly dependent on Canadian oil. So that's not really impacting the Canadian economy in any great way, nor is it impacting the Canadian stock market, really. The Canadian stock market, we would argue, is down in sympathy with what's going on in the United States. But when we look at the companies listed on the TSX versus the S&P 500, the S&P 500 companies are far more sensitive to tariffs because they are net importers versus the TSX, where we don't have many exporting listed companies. And so this is why we've seen the greater downside in the market really come from the US as opposed to Canada. We're down as well, but not to the same extent as the United States. Europe's not down as much as the US because this is really, coming back to the point of self-harm, this is Trump doing more harm to the U.S. economy and the U.S. stock market than he is to others around the world. From a positioning perspective, so that tells us, okay, if the U.S. has more to lose, then they have more downside, then we probably want to be underweight U.S. equities through this and favor other areas around the world because they're going to weather the storm better than what we see out of the import dominant US based companies.
And that sort of leads nicely into my next question in that, I mean, again, you and I speak about this all the time, and that's the importance of diversifying within your holdings.
Absolutely. And this is a great time where we can return to our portfolios and breathe a sigh of relief because diversification has been the investor's best friend through this, in that if investors weren't solely focused in U.S. equities and the Magnificent Seven because they've had the best run over the last 2 years, but have embraced more diversification, not just between geographies, Canada and the U.S. or Europe, but also different asset classes, bonds, gold, these other asset classes in a portfolio, when you compare how they've fared relative to the US stock market, it's a big difference. And we've seen that diversification has really balanced out portfolios. While even a diversified portfolio will still be down today, it's not down nearly as much as the broad-based US equity market. And that over time, continues to prove its value.
The other thing that's important to stress here is, corrections in the market are healthy and markets don't go up in a straight line. So while this may seem a little more extreme than some of the corrections that we've seen over the last couple of years, this might have happened anyway, though maybe not to the same extent.
Exactly. And this is where we actually get a little bit excited about what's going on. So first off, you're right. Corrections are unpredictable, but they tend to happen with certain frequency. Usually you get a correction, which is a drop of more than 10%, but less than 20% in the US stock market every other year. And it can be triggered by anything. It just so happens that this go round, the correction that we would argue was inevitable at some point, and whether it's this year or next year, was triggered by tariffs. But at the same time, we can learn from past corrections. And what I mean by that is they do come to an end. And you're right, markets don't go up at the same time, just like they don't go down forever. We're starting to see signs in the marketplace that we've hit this peak fear or peak pessimism that tends to correspond with the low point in the market or bottoms of the market. And there's a number of different indicators that we pay attention to, but they're all kind of flashing now saying, hey, we've hit this level, we've hit this level. And in the past, your forward returns from these levels and from these markers has been very attractive with a very high degree of probability.
Some could also see this as a buying opportunity.
That's the clear way of saying what I was trying to get at. Yes, that's exactly it. We think that what we've seen in the marketplace right now is representing a buying opportunity. And for investors that have been sitting on cash, waiting for an opportunity to get into the market, now looks like a good time to start doing that.
Well, never a dull moment in your world.
Not at all. I mean, this keeps it interesting and keeps it fun.
Thank you so much for taking time out to do this today. I appreciate your insight.
Absolutely. Great pleasure, Kris. Thank you for having me on.
That's Philip Petursson, Chief Investment Strategist at I.G Wealth Management. And that wraps up this episode of The Big Story. You can send us feedback on this episode or any other by emailing us at hello@thebigstorypodcast.ca. I'm Kris McCusker. Thanks for listening.